Hey everybody, this is David Skrika. So this is kind of take two. I did um this first video. So I decided I had kind of a brainstorm this morning. I've been talking about for months doing this kind of legends or gurus of investments series, but like I just didn't want to just like talk about one investor. So I wanted to make it more pragmatic in that I wanted to talk about like an investment that one of these gurus did that paid off. So that also means like we could talk about we could have a dozen different on great investors who had a lot of success. We can talk about a dozen different investments they made. So what's great about that, we can talk about their philosophy in action, so you can see how it worked, right? So today I'm going to talk about John Templeton. So we're going to talk about two of the investments he made. One kind of at the beginning of his career, and one closer to the end. So, and it's kind of interesting because they were both had to deal with, buying cheap assets. They were essentially 60 years apart. One he did in 1939, and the other he did in 1997. So, and he would have been in his mid to late 20s when he did the first one, and he was in mid 80s when he did the second one. So the first one was in 1939, and this is kind of probably his most famous investment, maybe because it was his first really great one. So he had just graduated from Oxford a few years early. He said that he acquired he made about $50,000 in the market, which adjusted for this, now he had about $1 million. So, in the 30s with the Great Depression, that would have been quite wealthy, but like, he was a very frugal guy. He didn't spend a lot of money, et cetera, et cetera. So he decided in the late 30s that he could see things building in Europe and that there was probably going to be a world war, and that he would want to buy companies in the United States because the United States would supply Europe, tanks, munitions, airplanes, the materials. So, obviously things like the Spitfire were built in the UK, but they needed this, the steel and manufacturing to do it. And then of course, this would spur manufacturing and especially and also transportation, things like railroads would have to move these goods and services, from the Depression levels. And a lot of companies were now extremely cheap because of the Great Depression and a combination of them being in financial trouble. Remember, there were two phases of the Great Depression. There was the one that's kind of the famous, the 1929 crash, followed by banking failures, followed by, the soup kitchens and soup lines and, massive unemployment and homelessness, et cetera, et cetera. And from 1929 to 1932, and then there was the 37-38 recession, which was very steep as well, is that, the New Deal came along, kind of spurred like a 4-year recovery from 33 to 37. And then Roosevelt decided he wanted to balance the budget. And I think it was a combination of just, it kind of showed that the government at that time, the economy was really dependent on the government. And, and then, the market went down 50% in 37-38. The economy went back into recession. Unemployment, which was gone from about 25% to 14, went to near 20. And then, so then you really had 10 years of this economic malaise. You think now we're just used to growth, even after the financial crisis. Most of the last 30 years, other than a couple of years of the financial crisis, a couple of months during COVID, and about a year of the dot-com bust, we've seen a growing economy. So just think of a period when you saw essentially, 6 years in a 10-year period where essentially you saw mostly negative growth, right? So all these companies that were cheap were also just anticipating this malaise would continue, but he decided that it wouldn't and that the war would spur it. So he borrowed $10,000, even though he had 50. So he had the money to cover it if the borrowing did not work, if the investment did not work. So 10,000 is about 200,000 today's money. He had about $1 million, right? And then he bought 104 companies, 34 in bankruptcy. In 1939, he called the broker the day the war started in September of 1939. And I think the famous story is that his broker got back to him and said, "Okay, these are the companies I bought. I just didn't buy the ones in bankruptcy." And Templeton said, "Buy them too, because they would do well." So one of the more famous ones he bought, he really liked the railroads because, again, he thought the goods and services would be moving again. So he liked Missouri Pacific Railroads, right? It had come public at $100 in the 20s, paying $7 a share. It had collapsed to 1939 to 12 cents a share, and obviously no longer paid a dividend. So his $100 bought 800 shares of the stock. This is a stock that $100 would have bought you one share, 10 years earlier. And essentially, and then it turned around. The stock went to $5. He made 40 times on his money. He sold it. It ended up going to 105. So he would have made he would have made like 8,000 times on his money, and probably had enough to retire on if he had kept it. But of course, there's no one ever goes broke by selling too soon or taking a profit, as the old saying goes. So one thing he said was that a lot of people just were not aware of how cheap, especially with the stock market crash and the depression. A lot of people didn't have money to buy equities, but also even people who did were just not thrilled with the stock market. Like the Dow was under 100 in 1938. That was still roughly a third or a quarter of where it was at its 1929 top. So in a 10-year period with things falling 3/4 in price, a lot of people just did not have interest in the markets, So anyhow, I think actually that 100 level in the Dow would have been where it was in 1907. So, you're talking stocks had not done anything for over 30 years. Kind of like, I guess, where we are right now with the Nikkei, but essentially, we've seen that happen. And so he turned that $10,000 into 40,000. So roughly $200,000 in today's money into 800,000. And then he sold, paid back the loan, and used that to kind of build his investment empire. He took his funds public in the late 50s. He moved to the Bahamas in the mid 60s. And what was interesting is he did not really start being this great investor till he moved to the Bahamas. And he said it was because he was not associated with Wall Street anymore, didn't get pitched the same ideas, could be more independent, et cetera, et cetera. And he was quite a middle-aged man then, even though he had done well. But, really it was from his mid 50s to really mid 50s, to mid 70s into the late 80s is when he had his greatest performance. So that's something interesting to know. If you beat yourself up because you're 40 or 50 or 60 years old and, maybe you haven't made as much money as you thought you could, you can look to Templeton. So then the next deal we're going to talk about is, and what I wanted to show you is look, this just shows you how stock picking can be important, because in 1939, when he made that trade, the Dow transports, I use the transports because, a lot of the companies he bought were railroads. They were trading at about 3,000. By the time the war ended, they were trading at about 3,500. So they had gone up about 15%. But again, his stocks quadrupled. Like that one railroad we just mentioned, went up 40 times in value. So it just shows you, if you pick the right stocks, even in a market that's not doing like it did well, during the war, because the market kept falling until the war turned. It was trading on the war rather than just earnings of the companies, which makes sense, because how great were U.S. companies going to be if the Nazis came and took over, So, so even then, it doubled roughly the transports from the low in 42 to the high in 46. But again, he made 4 times on his money, And so anyhow, and I think the Dow went up 20% or so. His next trade was in 1997. We had this Asian crisis where all these currencies were devalued. Essentially, a lot of these countries still had antiquated currency markets. They were really dependent on foreign inflows of money. Their economies were still kind of mercantilistic. We all know that Korea and Taiwan export a lot. They had their chip industries by then. But the issue was they didn't really allow for foreign competition, foreign money. It was very restrictive. So when the foreign money left, it would kind of really just crashed everything. So they had IMF loans. They kind of freed up their capital markets. And, Templeton could see the kind of growth that these economies could have. We all know that Korea has a big tech industry, chip industry, obviously automobile industry, like I said, tech, electronics, et cetera, et cetera. So he bought in during this crash, and you can see that the Kospi, the Southern Korean index, fell from over 800 to about 350. Now, and it ended up falling to 300 because all the Asian markets fell with Russia in 1998. So he bought a little early, but that's part of maximum pessimism. You're not always going to get the bottom. And by 2000, I think this is when he sold, it went to 1,000. It more than tripled in price. And Korea was one of the best performing markets in the world in 1999. And actually, it went up about as much as the tech stocks did. And it was a much safer bet because the stocks are much cheaper. And then ultimately, over the next 10 years, into 2007, 2008, it went to 2000 and went up nearly 7 times in price over that period. And after the dot-com bottom, the South Korean stocks really outperformed American stocks. The S&P basically doubled in price from the 2001 bottom to 2008 top, where this went up over 4 times in price. So, anyhow, him buying maximum pessimism, seeing the potential for growth. And I think that's one of the part of buying maximum pessimism. You also have to see the potential for growth in these markets as well. And that was one thing that he was great at doing. So hats off to Templeton. So those are two kind of, similar, buying cheap assets, buying beaten up markets, seeing the potential for growth. 2 trades that he made kind of near the, one closer to the end of his life and career, and one at the beginning of his life. And, in that 60-year period, the fundamentals still worked. And he did much, way more trades, which we'll talk about in the future. One reason I've always had an affliction for Templeton is that he has British citizenship. I have a British passport because my dad was born in Leeds. He moved to the Bahamas. I've moved to the Bahamas. I'm nowhere in Templeton's league. And so he's always been one of my favorite writers, and investors. I went to his memorial service in 2008. It's actually where I happened to meet Christopher Ruddy, the CEO of Newsmax, which some of you know me from my books and my newsletters through Newsmax. So I still write for Financial Intelligence Report, which is a magazine through Newsmax. I've written for that for almost 15 years, believe it or not. So, but anyhow, I just wanted to show you kind of his investment philosophy, how it worked, being a contrarian. And, the interesting thing about buying those companies that were bankrupt was, like I've seen recently a writer criticize a certain gold royalty company because it had so much debt. And I was like, this guy does not understand investing at all. That debt's bad if gold prices were to tank and they'll go under. But if you believe, again, gold stocks are cheap, we have the catalyst of probably the Fed, cutting rates next year, that company is going to be more leveraged than the better run companies. Like I've talked about a trading stock like Eldorado. Like Eldorado at times has not been a well-managed company. The losses, the expenses get out of control. But when the turns come, that makes Eldorado hyper leveraged play to gold, which my opinion is what you want, right? So, with juniors a little different because they don't have cash flows or earnings, but because you want good management there. But anyhow, I just wanted to show you that, so that's kind of interesting too, is you want to look for those kind of companies that maybe, and I did it myself. I remember with Athabasca, when I looked at that at 10 cents, and I sold too early, like Templeton did with his Missouri Railroad stock. I remember Athabasca, it was like, well, if oil stays, south of 30 or 40 for a few years, this company's going to go bankrupt. But if oil turns around, which I thought it would, and that there's a catalyst there, I'm like, this company is going to go way up, and it went from 10 cents to almost $4. It's about $3.50 right now. So anyhow, it just shows you how this kind of philosophy still works. So I hope you like this video. I'm going to do more. I'm going to do videos on Jim Dines, George Soros, Paul Tudor Jones, Peter Lynch, Martin Zweig, and they're going to be different for different reasons. Some of them will be great short trades. Templeton himself had a great short trade where he shorted tech stocks in 2000. Some will be great short trades. Some of them will be buying cheap assets. Some of them will be maybe I'll even delve into how Donald Trump originally made his money in real estate, because it was an interesting way of doing it. That was something that you needed a little more on the political correction side, but it was basically buying cheap assets as well, and then pulling those political strings. So it was an interesting way of making money. But Well, look, a lot of these things, I don't know if I'll do it every Wednesday, but I think I am going to do it every Wednesday leading up to Christmas because markets are tend to be slower, in December, and probably even leading up to New Year's. So we'll have, and then probably I'll do one a month. And again, the great thing about just doing specific trades like these, it shows these guys philosophy in action. And then it also means I could talk more about them. Like I can do probably 5 or 10 videos on Templeton, not just one talking about his entire life and career. So also along with this video, I've enclosed a YouTube video called Contrarian. It was a documentary made about him a few years ago. So feel free to watch that. It's not that long. I think it's about 50 minutes long. It's an excellent video. I watched it a few years ago. If you type his name in on YouTube, there's some great interviews with Charlie Rose, with CNN, Wall Street Week after the 1987 crash. So there's some great interviews with him. And it's funny because I was in kind of this negative part of something happening in my life earlier this year, and I got caught up in this comedy show. And I still like raunchy, vicious comedy, and I just realized it was a real negative thing, and it was making me negative. And then when I watched his videos in Templeton, and I was just like, wow, this is so much. I just have to get back to watching this sort of thing. I feel so much better than the other garbage I was watching, or other stuff I was watching. Comedian's still a very funny guy, but it's just it wasn't for me personally. It's in the longer term, it just didn't suit me. So anyhow, I thought I'd show you this, and I hope you enjoyed this video, and I hope you learned something about Sir John Templeton, and we'll have more of these going forward.